This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Tale of two stocks. Netflix beats earnings estimates, and so does IBM, giving investors in Big Blue something to cheer about initially. But there's more to the story. State of the Union. President Obama addresses the American people tonight, outlining new proposals that would change the tax code and impact your money. China's challenge. Growth in one of the world's biggest economies is at the slowest rate it's been in 24 years and comes at a critical time for the global economy. All that and more tonight on Nightly Business Report for this Tuesday, January the 20th. And good evening, everybody. I'm Bill Griffith. Tyler and Sue are both off tonight. Very pleased to be back with you tonight. We begin this evening with Big Blue, tech bellwether IBM, out with better than expected earnings last quarter, helped by its fast-growing cloud computing business and security software, and despite decreasing demand for its servers and storage products. Here are the numbers that came out late this afternoon. Adjusted earnings were $5.81 a share, easily topping analyst forecasts by 40 cents. Total revenue fell nearly 12% from a year ago to just over $24 billion. That just missed Wall Street forecasts. Shares were initially higher in late trade on the news, but then turned negative on weaker than expected forecast guidance for the full year. Bertha Coombs joins us now from the NASDAQ, including her one big takeaway from IBM's report tonight. Bertha?
Bill, the big takeaway is that IBM's float is getting smaller. The company went from just over 1 billion shares at the end of 2013, and as of December 31st, they had 991 million shares. A lot of people have said, as their year-over-year revenues have declined for 11 straight quarters under Virginia Rometty's watch now, the thing that has helped them on the bottom line has been this share buyback and share reduction. Some people call it financial engineering. But talk to some traders, with the share count now so low, below 1 billion for a company this size, it could very well make them vulnerable, perhaps, to an activist shareholder to take a really big stake and try to call the shots.
Something to keep an eye on from Bertha Coombs there at the NASDAQ market site in Times Square. Thanks, Bertha. Also out after the bell tonight, Netflix with blowout earnings last quarter after adding 4.3 million more subscribers. That was far more than expected. After adjusting for certain items, the streaming video service took in 72 cents per share, easily topping estimates of just 45 cents. Despite cost cuts and all those new subscribers, though, revenues were just a fraction below estimates, but up from last year. But after projecting to be a fully global service by the end of 2016, except maybe in China, shares soared in late trade, up as much as 13%. Julia Borston now from Los Angeles with her one big takeaway from Netflix numbers.
Netflix shares flying higher on the heels of better than expected earnings results. The key takeaway, it's all about international expansion. The company added more international subscribers than expected, 2.4 million, for a global total of 57.4 million subscribers. Another factor, lower than expected international losses, one main reason that earnings per share blew past expectations. Moving forward, international growth is a big focus. CEO Reed Hastings announcing the company will complete its global expansion over the next 2 years, earlier than expected, while staying profitable. Hastings saying in his letter to shareholders that one advantage of Netflix being global is that with all that scale, it'll be able to develop more originals and license more content. One international question, though, remains China, where Hastings says they are still exploring options. Back over to you.
Thank you, Julia Borston. Well, things weren't quite as dramatic on Wall Street overall during this trading day. The markets kicked off this holiday-shortened week with some very modest gains, but a flat finish is certainly a long way from the losses early in the session following some disappointing earnings. Another sharp drop in oil price we saw today, and concerns about that slowdown in China's economy that we'll talk about in a little bit. Here's how things looked at the closing bell today. The Dow and the S&P each ended 3 points higher. The NASDAQ was up by 20. Oil prices tanked nearly 5% today following forecasts for the slowing global growth in 2015. West Texas Intermediate crude tumbled $2.66 to $46.47 a barrel. Brent North Sea crude fell by 85 cents to just below $48 a barrel. In the bond market, the yield on the benchmark 10-year notes edged slightly higher. It was down to 1.76% at one time today, but there it is, just below 1.8%. Before the opening bell, a strong U.S. dollar and tough competition for some popular drugs added up to a tough pill to swallow for Johnson & Johnson last quarter as it missed Wall Street's revenue forecasts. J&J was the biggest decliner inside the Dow today, falling more than 2.5%. So what happened and what's ahead this year for the health giant? Meg Terrell has our story tonight.
For the world's biggest healthcare company, the fourth quarter was just okay. Growth continued in Johnson & Johnson's pharmaceuticals business, driven by a new drug for hepatitis C. The company's medical devices and consumer products units continued to struggle. But it was J&J's forecast for 2015 that caused the stock to plunge today, primarily due to a stronger U.S. dollar.
As the dollar gets stronger versus these overseas currencies, it means that the profits that multinational companies are generating outside the U.S. are being brought back at basically lower rates. Whether it's the euro, the yen, or some of the emerging market currencies like Russia, there's been a meaningful change in rates over the last 6 months. And so if you're a U.S. company selling products outside the U.S., you're going to get hit when that happens.
J.P. Morgan analyst Mike Weinstein warns the strong dollar means we're likely to see more disappointing 2015 forecasts from other large multinational companies. As for J&J, the tough 2015 also comes from increased competition to some of its key drugs, including hepatitis C medicine Olysio. Weinstein's looking to a recovery in the medical device and consumer products businesses to offset any slowdown in pharma growth. The health giant is still coming back from a series of recalls that took popular over-the-counter medicines like Tylenol and Sudafed off pharmacy shelves. And with more than $14 billion in cash, J&J could be a big acquirer of both consumer brands and biopharma products, according to Weinstein.
I think they should continue to do deals in pharma and biotech. Their track record there has been exceptional. So they've done a great job of using their balance sheet there. And I think after that, I think there is opportunity for them to reinvigorate their consumer business with acquisitions. And that can be established brands in the U.S. It also can mean increased emerging market exposure and opportunity.
So the world's biggest healthcare company could get even bigger. For Nightly Business Report, I'm Meg Terrell.
Also reporting ahead of the bell was Morgan Stanley, which saw fourth quarter profit rise to just over $1 billion, despite a slowdown in bond trading and weakness in its commodities unit, making the bank miss Wall Street forecasts. Shares today down almost 0.5% as a result. Switching to Washington now, as President Obama gets ready to deliver his 6th State of the Union address tonight, hoping to jumpstart the 2016 presidential debate cycle by tackling the deepening problems of U.S. income inequality and the dwindling fortunes of America's middle class. After a week of calling for new taxes on the wealthy, free community college tuition, and paid leave for federal workers, the president takes on the national stage tonight in front of what could be the biggest obstacle to his proposals, namely the new Republican-led Congress. John Harwood is in Washington with more tonight.
The things to watch for in the president's speech tonight are the tax and spending proposals he's going to lay out to try to lift middle-class incomes. On the tax side, he'd raise $320 billion over 10 years through two main methods. One is to adjust the capital gains tax system, raising the top rate to 28%, taxing for the first time the appreciated value of assets passed from one generation to the next. He would also impose a fee, 7 basis points, on the liabilities of the 100 largest financial firms with assets of $50 billion or more. He would use that money to provide new tax benefits for working families, a 2-earner tax credit, an expanded child tax credit, an earned income tax credit for workers who don't have children. He would also fund his proposal for 2 years tuition free of community college. All that would total $235 billion over 10 years. Look for the extra money to be spent in other ways in the president's budget, which comes out in a couple of weeks. Now, the people who would be subject to these new taxes can relax a little bit, not likely to pass in this Congress, but it is going to provoke a debate with Republicans, which they say they want to be part of, on what to do about middle-class incomes, which have been stagnant for the last 40 years. For Nightly Business Report, I'm John Harwood at the White House.
Let's turn to Greg Valliere now to talk more about tonight's State of the Union address. Greg is the chief political strategist with Potomac Research Group. Gregory, Happy New Year.
Good to see you, sir.
Nice to see you. So, okay, we've got this laundry list of ideas that will be presented to Congress tonight. None of them are, well, virtually none of them are expected to pass. What do you make of that? Is it constructive to make simply political statements from both sides of the aisle when nothing is expected to get done?
It's not constructive if you want to get anything accomplished, Bill, but at the same time, I think both parties, and it's a reason why people are cynical, both parties already are thinking almost exclusively about the 2016 election. So these proposals will frame the narrative for the next election.
And as far as taxes go, the president proposing higher taxes on capital gains and so forth on higher income individuals and lower taxes for middle class. Where does that go then? If we're looking ahead to 2016 and that debate, where do you think we will find middle ground?
Well, I don't think we will. I think the Democrats have done some polling or had some focus groups, and they've decided that the Republicans could be embarrassed or put on the defensive if their representatives defending the top 1% or defending Wall Street and the banks. So no, this is a pretty partisan argument, and there may be a few things done, Bill, infrastructure, a couple of things could get done, but I think on taxes, both parties are at an impasse.
This intriguing proposal about free community college for working individuals, where do you think that goes?
Probably nowhere unless you can find a different way to pay for it. It does look, Bill, as if the Democrats really want to make a target out of the banks. As John Harwood said, a bank tax on assets, or other Democrats on the Hill have talked about a Wall Street transaction tax. You need something to pay for these community college benefits. I just don't see how they pay for it.
One thing you think may happen, cybersecurity. Of course, everybody can agree that something needs to be done about that.
I think the hack of Sony was really a wake-up call, and there could be worse hacks to come. And I think both parties are coming closer and closer to a deal, including the president, that would allow the sharing of information as the federal government gathers information from corporations. I think we could get a deal there, Bill, and I think we could get a deal on infrastructure, maybe replenishing the Highway Trust Fund.
No government shutdown this time around?
That's an important point, Bill. I think that, unlike previous years, Mitch McConnell and John Boehner are determined not to have any shutdown, no debt ceiling, default crisis later in the year. I think Boehner and McConnell really want to show that they can govern, and they certainly don't want to have another crisis that could affect the markets.
Greg Valliere with the Potomac Research Group. Always good to see you, Greg. Thanks.
You bet.
Still ahead, what China's slowing economy could mean for growth in the U.S. and across the globe. More now on the International Monetary Fund lowering its forecast for global economic growth in the year ahead and its call for governments and central banks to jumpstart growth with new monetary easing policies and reforms. The IMF says that global growth is now projected to rise by 3.5% this year and 3.7% for 2016. Now that's down by about a third of a point for both years. The lone bright spot for growth is here in the United States, where the IMF actually raised its forecast for growth for this year. More now on that disappointing growth in China's economy last year. Still pretty high, of course, but it is the slowest in more than 2 decades. So what's behind the downward spiral, and what are the challenges that China faces in the year ahead? Eunice Yoon has more tonight from Beijing.
China's GDP came in at 7.4% for the year. That's largely in line with the government's target of about 7.5%, but it's also the slowest growth that the country's seen since 1990. What's weighing on the economy? A weaker housing market, soaring debt, also overcapacity in several different industries. And those issues are probably going to challenge the economy for the coming years. The IMF is the latest to weigh in with some downgrades for the coming years. They downgraded the outlook for 2015 to 6.8% from 7.1% and 6.3% for 2016. Now, the report card today intensified the debate here over what Beijing should do and what Beijing will do. There have been several calls by many economists who believe that the economy is going to need some support, that Beijing should step in with some sort of stimulus. But the IMF said that the main reason for their downgrade is because they believe that the authorities are going to be willing to sacrifice short-term growth in order to reach a longer-term goal of rebalancing the economy and pushing through reforms. They believe that Beijing is going to be very careful with its policy response in 2015. For Nightly Business Report, I'm Eunice Yoon in Beijing.
John Rutledge now joins us to talk more about the slowdown in China and what it means for the rest of the world. John is Chief Investment Strategist at Safinet. Happy New Year, John.
Happy New Year, Bill. How you doing?
I'm doing fine. You've been an early champion of the Chinese economy. You were among those back in the 80s, I can remember, who said, watch out, China is the sleeping giant that's going to awaken. Now we have this growth rate, though, that's the slowest in a generation. Is that all part of the plan, or does that come as a surprise to you?
Well, you know, it's interesting, Bill, because it's growing the lowest number it's grown in the last umpteen years, but the number also was above forecast, above consensus. They were growing 7.5 roughly. If they grow 7 this year, upcoming, that'll be twice the rate of the U.S. They'll make twice the contribution of the U.S. to the global economy, and it'll be twice the value of what it was 10 years ago. The thing is, the Chinese economy has grown so much so long that it's now grown up, and it's about the size of the U.S. economy in purchasing power. So 7% growth of that big beast is a lot of money compared to either what we're doing or they're doing abroad. But Chinese economy is changing, as the IMF report said. Less heavy manufacturing, less infrastructure, less investment spending, more consumer products. So you have to be aware of that.
So a maturing economy, and with that less infrastructure, they're not buying as much in terms of materials. So do we see a decline in materials costs globally as a result of this? Is that what we're getting at?
Yeah, you're right, Bill. We've all been trained to think of Chinese growth as meaning higher copper prices, aluminum prices, steel prices, zinc prices. But the fact is, those are the parts of the economy that are shrinking now, and the parts that are growing are consumer goods. You know, if they grow 7% in real terms this year and 3% inflation, that means the average person in the average city in China will have a 10% increase in their income. That's what's driving the consumer side of their economy. So where you want to be careful about that is countries like Australia or Chile or other resource producers that have been making a lot of money out of this that won't. Australia in particular, with lower oil prices and energy prices, coal in particular, and lower materials prices, is going to hurt their economy, but also their currency this year.
If you're going to make an investment there, you like Chinese real estate, but you don't like their stock market. Why?
Well, actually, I like their private equity market, and the reason is the following. It's a structural reason. In China, the big banks were created to loan money to state-owned companies, which is a smaller and smaller share of the economy. The growth in China is almost all private, fast-growing companies. They don't have a banking system to feed it, so this shadow banking system has been invented and created just to feed that growth. Private equity is where that money comes in. Sale leasebacks of corporate office buildings, that kind of thing. The stock market, though, is not ready for Broadway. They don't have the audits. We basically don't trust the institutions the way we would in a country where they have judges with long black robes. So I like to stay away from that.
So in 20 seconds, for people watching who want to participate in the growth in China, how do they do that then?
Well, at the moment, because the Chinese stock market has gone up so fast, I want to get some distance and stay away from that market for a while. If we see a big correction, I might change my mind later in the year. But right now, I want to own no Chinese exposure, no Chinese equities. And private equity in China is just too difficult to get to for most people. Right. So for the moment, make your bets on the U.S. economy. That's where the real growth is going to be this year.
All right. John Rutledge with Safinat. Always good to see you, John. Thank you.
Good to see you, Bill.
Elsewhere, as crude craters, layoffs are mounting in the oil patch, and that's where we begin tonight's market focus. Baker Hughes and Halliburton both are the latest oil field service providers to announce layoffs. They are cutting a combined 8,000 jobs, and along with that, both companies announced earnings that topped estimates on strong demand here in North America. Halliburton is actually in the process of buying Baker Hughes, as a matter of fact, right now. Shares of both companies rose more than 1% today. Not everyone, though, is suffering because of those falling crude prices. Delta Airlines says that lower fuel costs should save that company more than $2 billion this year. Its results topped estimates, as it was also helped by an increase in passenger traffic. Shares soared by 7% on Delta to $49.17. Outer Wall, that's the parent of Redbox, those video rental kiosks, announced some executive changes today. Its CEO is stepping down and resigning from the board. No explanation was given, and another board member was appointed as interim chief. Investors didn't like that. Shares plunged as a result by 20% to $62.05. Investors, though, bought up shares of Smith & Wesson in today's session. The firearms manufacturer hiked its financial guidance for the third quarter and for this year, citing improving consumer demand for guns. Shares rose 16.5% to $11.67. And it was an interesting day for shares of Orbitz. That stock was halted at one point, then it was reopened on a report that the online travel site is exploring a possible sale and has drawn interest from private equity firms as well as other internet companies. And as you can see, shares popped midday, closing 9% higher to $9.95. That story's not over yet. PepsiCo elected one of Trian Fund's advisory partners to its board. Trian, of course, is led by activist investor Nelson Peltz. They've been looking to split up the company by separating its snack division from its beverage business. Shares of Pepsi rose slightly today to $97.51. And Shake Shack has come a long way from selling upscale burgers out of a single push cart in a New York City park a decade ago. It is now planning to raise up to $80 million in an initial public stock offering. The burger chain now has 35 U.S. locations, more in the Middle East, in Russia, Turkey, and England, and it expects to put 5 million shares up for sale now, priced between $14 and $16 apiece. Don't know if French fries are included with that, though. Coming up, why lawmakers in the country's biggest city are zeroing in on a startup that's trying to change the way the hotel industry works. More fallout now from the Swiss National Bank's decision to remove its cap on the franc versus the euro last week. That, of course, sent the value of the franc soaring. Last week, shares of retail foreign exchange broker FXCM plunged after it lost $200 million on the franc, forcing it to seek a bailout loan just to stay in business. Well, today, shares plunged even further, down another 87%, after we all learned the terms of that loan it received from Leucadia National Corp., namely a staggering 17% annual rate on the $300 million loan. A big win, though, for big credit card companies. The U.S. Supreme Court has upheld a lower court's ruling regarding the so-called swipe fees that retailers have to pay card issuers every time a debit card is used at the checkout counter. The highest court in the land declined to hear an appeal from the National Retail Federation, which was arguing that a 21-cent per swipe cap set by the Federal Reserve 4 years ago is still too high. That story may be finally over. Finally tonight, a heated public hearing in New York City over a company that has shaken up the hotel industry. Officials are trying to decide whether Airbnb's short-term home rentals are legal and whether the popular service is taking some much-needed apartments off the rental market. Kate Rogers has our story tonight.
The sign of a truly disruptive company is clashing with the regulatory establishment. The theme has been a common one for the growing sharing economy, with ride-sharing services Uber and Lyft facing global opposition. Today, home-sharing startup Airbnb's fight went to City Hall. New York City Council members heard testimony from a variety of groups: Airbnb members, the mayor's office of special enforcement, and tenants who say the service is exacerbating the affordable housing crisis in the city.
When you are taking a whole building, which in some cases is done, we don't know if those would have been rent-regulated units. If you're taking 1 or 2 units in a building, for instance, that impacts the health and quality of life for the other residents in the building.
In fact, in a report released last fall, New York Attorney General Eric Schneiderman said nearly 75% of Airbnb rentals in the city are illegal. Airbnb says it's fine to weed out illegal hotels, but argues the city stands to benefit by legalizing its services. The startup claims it's generated $768 million in economic activity in 2014, and guests paid an estimated $33 million in sales tax and money spent at local businesses in New York City alone. Supporters say they don't mind taxes or regulations. They just want to see them made clear and want to be a part of the conversation.
I don't think that we're taking anything away from the economy of the city, because all of our guests are mostly international travelers, are coming and spending money here and boosting our economy in our city.
I'm not a legislator, so I'm not going to try and write the laws, but I'd like to sit down at the table with the legislators and contribute to them our ideas.
Regulators say those sharing their homes have to abide by the law. They must be present in their home while it's being rented out, it must be their primary residence, and the rental can't be less than 30 days. Airbnb's fate in New York City does remain to be seen, but last year we saw big cities like Portland and San Francisco allow the home-sharing startup to collect and remit hotel taxes, which of course is a huge move for the sharing economy. In New York City, for Nightly Business Report, I'm Kate Rogers.
And that is Nightly Business Report. I'm Bill Griffith. Thanks for watching. See you tomorrow.